What we really need to think about if we're a real estate investor is what happened 25 to 30 years ago. That means if you owe $1 million in mortgage debt, inflation basically paid $270,000 for you. I mean, that's free money. If you don't pay the debt yourself, wow, you got a free ride on that, maybe some positive cash flow, a ton of tax benefits because income property is the most tax-favored asset class in America. You know, Kevin, it reminds me of all the corporate raiders that became sort of famous in the 80s. What was the big strategy they used? The LBO, the leveraged buyout. I think inflation is going to be a theme for quite a while. Of course, there are cycles and everything. There will be bouts of disinflation or even deflation on the way. If you're a real estate investor, demographically speaking, you're in good shape till about 2045, 2048. The media loves to talk about California, New York, right? These up and down places because there's just a lot more to report on. If it bleeds, it leads. That's the saying in the newspaper world, right? Well-known economists and well-known think tanks have just gotten this totally wrong.
Welcome back to another episode of The Meet Kevin Show. We are here with Jason Hartman. You have some big things to say about a crash coming in real estate, but a specific part of real estate. And it's even beyond just office. So I want to talk to you about this because this is really interesting, especially with what we're looking at. And then you've also got some interesting insights in commodities.
Yeah.
So let's get started. What's going to happen? Are we going into a recession? Should everybody just sell everything and sit on the sidelines? Where's your head on that? And let's talk about these two insights.
Yeah, so quite a few things wrapped up in that question, Kevin. And I think the thing we have to consider is when we look at just housing specifically, most will agree we have a housing shortage. And you really have to divide up the country or the world really into three types of markets: linear, cyclical, and hybrid markets. Cyclical markets would be my home state of California. Don't live there anymore. I know that's where you are still. And that would be mostly a cyclical market where, boom and bust cycles. Looking at a chart over time, it looks like a roller coaster, glorious highs, ugly lows. But I prefer those sort of linear, boring markets. The center of the country, the southeast, right? Those kind of markets where there are ups and downs, but they're not as pronounced.
This would be like the Ohio or Carolinas, maybe, as an example.
Yeah, the Carolinas, but even Florida, Georgia, a little bit too. Not as much as it used to be because everything has bubbled up, as we know. And with those markets, they're more sustainable because you have better cash flow. And you can always tell a linear market versus a cyclical market by the land value. And so about 20 years ago, I started teaching a concept I call packaged commodities investing. And most people, when they buy a property, they think it's one thing, but it's really two major things. There's the land component, and then the improvements sitting on the land, the house, the apartment building, the office building, the retail center, whatever, which is made of commodities. And those packaged or assembled commodities, right? What are they made out of, right? Well, they're made out of copper wire, drywall, glass, steel, lumber, concrete, petroleum products, all of that good stuff. And those are relatively stable. What fluctuates the most is land value. Because land, when there's cheap, easy money in a market, land values just get bid up through the roof. And it doesn't need to be vacant land, just high land value markets like California, for example, right?
During an easy money cycle.
Yeah,
okay.
Right. So those get bid up a lot and they're very volatile. And I use the example of the last house I lived in California. I bought it for $815,000 back in like 2004. At the peak, it was worth $1.3 million. And it went up almost $500,000 in less than a year.
Oh my gosh.
And I mean, that's insanity, right?
Oh, that was 04 to 05.
A little later than that.
Okay.
A little later than that. But that's obviously not sustainable, right?
Yeah.
And so when you think about it, which component went up? Was it the land or the improvement? Well, the improvement, the house sitting on the land, actually did get a little bit more expensive because all those construction materials went up in price.
But not or 500K worth.
Not that much. So it's mostly in the land. And then when it came back down, which it inevitably, unfortunately did, right? Came back down to earth, what went down? The land value went down because it still cost almost as much to build the house as it did at the peak, right? And so when you look at things like that and you think of, I know George has been on your channel and he likes Jim Rogers a lot. I'm a big Jim Rogers fan too. He's been on my show a few times, and he's really interested in commodities. And I think commodities are one of the few things in the world that really have intrinsic value, whereas paper currencies don't have intrinsic value. And so everybody needs these commodities because they create one of the three major things. We all need food, clothing, shelter, right? So they're the ingredients for shelter. Wow. And so when you invest like that, and you invest mostly in the commodities and less in the land, that's a really conservative, prudent type of real estate investing.
That would be the more linear approach, likely.
Absolutely.
Okay.
Linear markets.
And where are your favorite markets for that?
Yeah. So, Tennessee, Florida, Georgia, Texas a little bit, but Texas has gotten a little bit expensive. But we've helped hundreds, or really thousands of people over the years buy in Texas. But Arkansas is quite good too. There's a lot of these like linear markets, Missouri, Kansas, these types of markets that just don't get a lot of attention from the media because they're kind of boring, right? Indiana is another great one. And nothing much happens there. So the media doesn't report on them because they're not sensational. The media loves to talk about California, New York, right? These up and down places because there's just a lot more to report on.
Drama.
Yeah, more drama. Yeah, absolutely.
Political drama or whatever it is.
If it bleeds, it leads. That's the saying in the newspaper.
How
world,
interesting.
Right?
So this is why, Kansas or Arkansas or whatever might not be on the news every day, but it's San Francisco, it's New York City or Miami. Right. Yeah. Interesting. Okay. So what does that mean in terms? So that's a good baseline. Where do we sit in the market now, though? So we've got 7% on the 30-year mortgage. What's at risk here? Is it the single family, the multifamily? I mean, we know office is in the poopers, but...
Right, yeah. My office is definitely in the pooper. That's a good way to say it.
Yeah.
So, multifamily is pretty oversupplied right now.
Oh, wow.
But that'll recover.
Okay.
It's just going to take 2 to 3 years to work.
Is that a buy
out.
the dip opportunity, or is it a careful wait like it's a falling knife?
I don't think it's quite there yet. I think it's still a falling knife.
Oh, wow.
I mean, obviously, look, I just want to make the kind of general disclaimer that lots of people, you can make money lots of ways and lots of things. Every deal's individual. There is no real estate market. Okay. There are individual deals, right? But generally speaking, I think multifamily it's got a little more pain ahead. Because there's a lot of new supply coming on this year. And there are quite a few syndicators that got themselves into trouble syndicating multifamily. And they're already selling, but I think there's going to be more of that.
Oh, even as rates come down, they're just going to flood them out?
Yeah.
Because they have to?
Yeah.
Okay.
Yeah, they're under a lot of debt pressure because they didn't plan for these higher rates. And they had a lot of short-term debt, which has come home to roost.
Like 3, 4, 5 year kind of debt?
Yeah, even shorter.
Really?
I mean, a typical strategy in multifamily, and I've done it myself because I've owned, a few big apartment complexes too. And, you buy, you rehab, and you re-tenant the property. So as the units go vacant, one at a time, you rehab them, and then you raise the rents by hopefully 30%. And that's a great strategy. And it works great. As long as you don't have cheap short-term debt that is no longer available, then you're in trouble, right?
Right, because you need to rely on somebody else to be able to get that cheap short-term debt. And
Ultimately, after you get past either the hard money loan or the fix and flip loan, the short-term financing, the bridge financing, then you need to go into longer-term permanent financing. And when that cost of money triples, you're screwed.
Oh, wow.
Okay, that's like a big problem.
And so you think there are a lot of screwed owners?
Quite a few.
Oh,
yeah.
wow.
And there are smart investors that are creating rescue funds, right? Rescue capital, they call it. Wow. And they're coming into that market now a little bit, but I think the bigger opportunity is still ahead. Wow. Because I think we're going to see more pain there.
Wow. Okay. So the opportunity for somebody watching, where is it? Is it the usual like buy your house or like wait and try to buy a fourplex, or what do you see?
I just my favorite is just the humble single family home. Okay. It's not that sexy, but those are really the best investments that aren't that sexy, right? And so just good old single family homes in linear markets, when I first started helping investors buy nationwide 20 years ago, I mean, these houses were $80,000, $120,000. Now, we're talking $350,000, okay, for that type of house. But that good starter home, that entry-level home that has been massively underbuilt for the last 15 years coming out of the Great Recession. There's a giant gap in the market, a big hole where we have a lot of demand for those properties and very few of them available. So that's another thing that we need to say. You can segment the real estate market a lot of different ways, right? We talked about linear, cyclical, and hybrid. We can talk about different asset classes, apartments, office, retail, industrial, all of this stuff, right? But also just within residential single family, price ranges, right? Market areas, right? There, condos, single family, fourplexes, duplexes, whatever, right? So there's a lot of different ways to segment things, and the entry level single family homes.
Entry level.
That's where you want to be. The bread and butter single family homes that make good rental properties.
Okay. So something that'll be easy for you to rent out in the future. Now, is there a potential crash coming then? That cyclical crash coming to single family this cycle? Like, are we in that cycle now?
In the broader single family market, I don't think so in any major way, but I'm not saying that with a ton of confidence.
Okay.
I just want to hear that. In the entry-level single-family market, I'm very confident that we are not looking at a crash yet. I mean, barring some black swan event, World War III breaking out, another pandemic, whatever, right?
Yeah.
L inserted on purpose.
Right. Yeah.
Hope the algorithm didn't catch that.
That's all right.
So, that barring one of those black swan type events, I think, just the dynamics of, we only have 500,000 homes for sale in the country. We have about 140 million housing units in the country. Okay. And Kevin, where so many people have gotten this wrong, so many experts, have gotten this wrong, big, well-known economists and well-known think tanks have just gotten this totally wrong. Since we saw this massive rate hike, only about 5 million properties, single-family homes, have transacted.
Between the beginning of rate hikes and now.
Yeah,
right.
In the last year and a half.
Yeah,
okay?
Wow. Which is well below the normal level. Yeah,
absolutely. So at the peak of the market, we have about 6 million properties a year transacting, selling.
We're less than that in 18 months.
Right. And so last year we had like 3.8 million. So sales are way down. Realtors are starving. They're complaining. All the settlement people, the mortgage people, they're all complaining.
Escrow title, yeah.
But there's a difference between sales volume and sales prices. Right. And the reason is simple, basic fundamental law of economics, supply and demand. Okay. And supply is very constricted because we have this lock-in effect of so many people with really low mortgage rates.
The 30-year fixed rate.
Yeah. 25% of the country has a rate at or below 3%, and they have 27 to 28 years left.
Yeah.
They're not giving that up. That's an asset.
Right. Yeah.
Okay. 65% of the country has a rate at or below 4% for 27 or 28 years left. Right? That's an asset. And if they were to move, literally renting an apartment would be more expensive. Moving to a cheaper house would be more expensive. So it's like this perverted, weird situation that has never happened in my multi-decade career. I've never seen this before. It's an unusual scenario.
So there's this talk about, and the rates will start coming down. Maybe prices will start going up again in the spring. Yeah. Is there a risk that as rates come down, inventory comes up more than buyers come in?
That is a fantastic question. And the answer is yes. Inventory will increase as rates go down, oddly, because the delta between current rates that people hold, those cheap rates, and the new rate gets smaller. And then trading happens. Right. There's less punishment. Hey, if I've got to pay 7%, and I've got 3% already, I'm not trading. I'm not going to sell, right? I'm going to keep my 3% even if I don't like the house, right? But if I can get 5% and I've got 3%, that gap is not as big. So then I'll trade. So that will create more inventory, but that'll also create more affordability So millions more people will be able to afford to buy, and that will light the market on fire again. So in a low inventory market, increasing affordability, we all know what happens because we had that during the COVID era, right?
Now the question is, how much of each do we get, I guess? And anything can happen.
It happens, it doesn't happen in a day, right? It happens over a continuum. And so as rates come down, a few people peel off, a little more inventory comes on the market, but a few more buyers can qualify now. So that all works, right? Wow. It's not a recipe for disaster.
So no big housing-led 2008 again, huh? 2.0 ahead of us.
Totally different circumstances. And I hate to say, we all know the famous last words of every investor. This time it's different, right? That's not good thinking, but it really is very different. Okay. I mean, in leading up, I predicted the housing crash in terms of the mortgage meltdown component. When I was doing seminars and speaking engagements in 2002, 2003, I knew, because it was really simple to see, that all the people that got these 3-1 arms or 5-1 arms, they would have adjustments and they would have payment shock. And they did. And that happened. So I sold my real estate company. I had a traditional real estate company in Southern California. Coldwell Banker bought it from me. It closed November 11th of 2005.
Oh my gosh.
And everybody said my timing was perfect.
Yeah,
right?
because prices started going down right after that, slowly.
Absolutely.
Yeah,
right.
Because it didn't really go kooky until like 07, 08, but at the end of 05, that was the peak.
Right. And, people didn't notice that, Kevin, at the end of 05, it was the peak. And the reason they didn't notice it was the holidays. And traditional, owner-occupied transactions don't happen that much then. But by the time we got to spring of 2006, people started to notice, like, where's the activity, right? It should be really busy right now. And it wasn't. And so that was the change. But where was I going with that? Anyway, I don't know.
No, that's okay. Yeah. So I guess
different circumstances and mortgage meltdown. That's where I was. So basically, I knew, and other people knew too, that there would be payment shock, and that happened. So the mortgage meltdown was kind of easy to predict because the lending was so loose. You knew what was going on there too. Okay, that was obvious. But what I didn't know is the theme of the movie Margin Call and The Big Short.
All the collateralization.
I did not know what Wall Street was doing. All the scamminess and corruption going on.
Amplifying the garbage.
Right.
Okay.
Right. So there were really two phases to the Great Recession. There was the mortgage meltdown phase, which was just loose lending and adjustable rate loans adjusting, payment shock. Right. But then there was the crookery and corruption and graft on Wall Street, which was selling the same loan in the same pool 33 times, and the loan literally didn't exist. There was, just massive underwriting fraud. I mean, look at Moody's. We all know the story, right? Because we saw the movies or read the book.
It's remarkable. Yeah. Okay, so that's not what we're looking ahead towards. Are you concerned at all about inflation or the Fed or recession coming? Like what? How are you positioning, and how do you see other people?
Yeah, I think inflation is going to be a theme for quite a while. Of course, there are cycles and everything. There will be bouts of disinflation or even deflation on the way. But look, we have got $34 trillion in debt. We've got somewhere between $60 trillion and $220 trillion of unfunded entitlements or promises the government has made in the next 10, 15 years that it can't afford to keep. So for reference, the federal government takes in about $4.7 trillion a year. So how is it ever going to pay back $34 trillion and then keep the promises to pay $60 to $220 trillion? It's impossible. You can't raise taxes enough to solve that problem. And if you raise the taxes that much, the economic activity will just dissipate.
Destroy the economy. Yeah. So you really have to hope that somehow the economy expands faster and the debt becomes less relevant over time, I suppose. Okay, interesting. How is that affecting your investing? Or are you just focusing on single families?
I think it means inflation. So, I think single family homes are the best thing because one of the things, the hidden wealth creators, is the mortgage asset. Even if it's not one of those super cheap mortgages we already talked about.
Principal paid on every month.
But you get to pay the debt back in cheaper dollars over time. Yes. The debt is inflated away. Yes. Yeah. And so that's really the business plan our government has for its debt.
Yeah. So why not do the same thing?
Yeah. If we owe $1 trillion to China and we have 10% inflation either in 1 year, 2 years, 3 years, doesn't matter the time, right? But we have 10% inflation. We just got a $100 billion discount on the debt. Right?
So we want as much inflation as possible. So really you're saying Jerome Powell is incentivized to run that money printer.
I think the whole system is incentivized to just inflate away debt and inflate away problems and kick the can down the road. And eventually the jig will be up. You can't do this forever, but we can do it for probably quite a lot longer than we think.
How long?
I don't know.
100 years?
Nobody knows.
10 years?
Maybe longer than we can live. I don't know.
Not 10 years.
I don't know.
Okay.
Yeah.
Okay. So what does this mean for demographics?
Well,
and the wealth gap.
Yeah. So the wealth. So the Cantillon effect, which I'm sure you're familiar with, right? This economist from 150 years ago talked about how the people closest to the money printer get the richest, right? Yeah. Because they get the advantage before the value is inflated away, right? And the rest of us little people, we get the advantage much later, and we don't get their advantage. So the wealth gap is increasing. Wealth is definitely concentrating. We've certainly seen that over the past 20 years. One of the things I say on my show always is you must watch old TV shows, watch old movies, read old books, listen to old music, because then you get a reference point. And when I say old, I just mean like the 80s or the 70s, not even that old, right? Yeah. And you just see the depiction of like a rich person in the 70s. Versus today, these are like mega rich oligarchs we have now. So that wealth gap is definitely increasing quite a bit. And, I think that's going to continue to happen. Unfortunately, I don't think that's good for society at all.
But that's the direction it's going. Yeah. So get on the ride or you're...
Yeah, and the way you can get on the ride and ride on their coattails and game the system is by getting cheap fixed rate long-term debt and letting it get inflated away. Most people with real estate, they think, hey, I made money because the property appreciated. But the properties don't usually appreciate that much more than the inflation rate. That's not that significant.
Yeah, maybe 1%, if that.
It's a bit of an illusion, right?
Okay, yeah.
But they do appreciate, they hedge inflation.
Yeah, there you
right?
go. Okay.
So if you leverage them, then you get a multiplier effect, right? So if you've got 10% down and the property appreciates, say, at 6% a year, then that multiplies to 60% gross return on investment, right? And if inflation is 6%, you have outrun inflation by 54%. That's a great deal. Okay?
Fantastic deal. Yeah, that's very interesting.
Then if you're getting tax benefits.
Yeah, because your debt isn't affected by this inflation because it's not going up because there's inflation. It's actually staying the same. So therefore, like you said, it's easier to pay it back.
Right. And the great thing about income property is we don't pay our own debts.
The tenants do.
We outsource the debt to the tenant. Yeah, it's the greatest deal ever, right? So you basically get in the middle of this awesome transaction, right? Because you have inflation-induced debt destruction, where the inflation is paying the debt for you. Give you an example, okay? So in one of my presentations, I show an example of how over the last 10 years, there's been 26.7% cumulative inflation. When inflation was lower before the COVID era, right? Just up until 2020.
Just comparing to 2019 or so,
Yeah. So that means if you owe $1 million in mortgage debt, inflation basically paid $270,000 for you. Yeah. That's free money. But if you don't pay the debt yourself, wow, you got a free ride on that, maybe some positive cash flow. A ton of tax benefits, because income property is the most tax-favored asset class in America, and it's the most historically proven asset class in the world, I believe. Happy to debate that point if someone wants to. And then you've got the leverage. You've got all these multidimensional characteristics.
It's amazing.
Yeah. It really is an amazing asset. Kevin, it reminds me of all the corporate raiders that became sort of famous in the 80s, right? And what was the big strategy they used? The LBO, the leveraged buyout, right? And the leveraged buyout, basically, the strategy is you find a company you want to acquire, and private equity firms do this all the time. It's their major strategy. You find a company you want to acquire, you load that company up with as much debt as possible, and then you make the company pay the debt back out of its own cash flow, okay? And then you ultimately sell it, or you split it up into parts and sell the parts, right? And so that we're basically doing leverage buyouts with income property. That's just a great strategy.
Okay.
Yeah.
I love that. That's fantastic. So what about the demographic issue? I know you've touched on this before.
Yeah.
I mean, there's immigration, the birth rates. What keeps you up at night?
Well, I mean, we're going to have a population bust, but that's a ways away. We don't need to worry about it yet, but it's definitely coming. And the great thing about studying demographics is it's immutable. You just know it's going to happen, right? It's easy to predict with simple math, right? If someone is, 30 today, they're going to be 31 next year, right? That's without a doubt. That's not debatable. Okay. And so there is definitely a baby bust. I mean, all these factors, feminism, all of these other factors have gotten us to a point where people just aren't having kids. And that's not what we worry about today. What we worry about today with real estate is household formation.
Okay.
That's the more important thing. So
which we had in COVID, but some were saying that might be like faux household formation almost. I don't know, because people wanted to get away from anybody.
Well, yeah, and the mass migration that occurred.
Okay.
But what I'm talking about is it's, some people worry about what's happening, the last several years, right? What we really need to think about if we're a real estate investor is what happened 25 to 30 years ago. Okay. And that's pretty good for a while. Okay. So if you're a real estate investor, demographically speaking, you're in good shape till about 2045, 2048. You've got a while. So don't worry about it yet.
So in other words, when the millennials who are not having kids start messing up our future economy.
Well, I don't want to say messing up, but if you don't have kids, you don't have an economy. And that's one of the big problems. I know George was talking on your show about Japan. Okay. So Japan has among other problems, right? Japan has a big demographic problem. And, they just don't have children. I mean, there's all these weird things in Japan. And I love Japan, by the way. I've been there twice. It's just a super civilized country. Everything's clean. People are so polite. It's a wonderful place. But there's like these weird trends. There are women that marry themselves. It's kind of like the Dennis Rodman thing, right, in Japan. And they literally have a wedding with no husband, no groom. Yeah, they hire a photographer, they invite their friends, they have a party, and they have a wedding with no other person.
So what's the point?
It's just weird. Look it up. It's just a weird thing. I don't have a point. But this is the problem. When you don't have kids, you can't have an economy without children. You're doing your part.
Oh.
So congratulations.
Thank you.
Thank you for doing your part.
Yeah. Wow. Okay. So buy real estate, buy single family homes and go have kids.
Yeah. So, maybe you'll just tell everybody have more sex.
Yeah.
Okay?
Yeah. There you go. Perfect.
There you go.
Yeah.
I'm sure everyone will like that message. But, there are other assets, obviously. There are precious metals. The problem is you can't leverage them very well.
Bitcoin.
You can't rent them out. I'm going to say Bitcoin next. That's coming. So Bitcoin, obviously, the ETF was just approved. I don't have like a ton of confidence in Bitcoin, but I hope I'm wrong. I want to be wrong about this because I would love nothing more than to see a decentralized currency of the people take over the world. I would love that. The reason I don't have a lot of confidence, though, and I do own some, and I buy it every week. A little bit. I just dollar cost average. Okay. But, the two most powerful entities the human race has ever known are governments and central banks.
And Bitcoin's threatening both.
Their main product is their fiat currency.
Yeah, of course.
I mean, that's the product of any government is its currency.
Yeah.
Okay. And they're not going to just stand by and let that be displaced.
Of course.
I mean, they have standing armies. Okay, Bitcoin does not have a standing army.
Wow.
And so I just think there's going to be a lot of headwinds.
Wow. That's a big warning.
But I hope Bitcoin wins.
Yeah.
Okay. But I wouldn't put all my eggs in that basket, I'll tell you.
10%?
I don't know.
5, 2, 1?
Depends how much money you have.
I guess.
It's different. If you have billions of dollars, you can put a bigger share in there because it won't affect your lifestyle if you lose it. All right.
Oh, okay.
Yeah. And the other big threat, I think, to Bitcoin, and by the way, I want to separate Bitcoin from every other cryptocurrency. It's in a class by itself.
Okay. Even versus Ethereum, let's say.
Ethereum is a centralized, that's not Bitcoin.
Because of the staking pools where so much is in one pool. Okay. Yeah,
Nothing is Bitcoin.
Okay.
Except Bitcoin.
Got it.
Right. And other cryptocurrencies, you can speculate with them and make money. I have a lot of friends who've made a ton of money. I mean, with that stuff. But Bitcoin's in a class by itself. That is the leading thing. But the other big threat to it is coming around the corner, and it's quantum computing.
Oh, wow.
These ultra mega powerful computers that we can't even comprehend really are right around the corner. And, they could crack the blockchain. They could crack the code. I'm no expert in that, but I think that is a legitimate
to update some of the cryptography a little bit before quantum computers take over, right?
That would scare me.
Okay, interesting. But that wouldn't be your main concern if you, as an investor, is the cryptography. It would be more government.
Yeah, governments and central banks, I know they will.
Governments and central banks with quantum computers.
Well, that's even worse. Yeah. Well, or with laws and armies and police forces. I mean, look, like with the cryptocurrency and the Bitcoin argument, right? They say, well, they can't stop it. Are you sure about that? I mean, look, they can just make it illegal. And then you say, okay, look, well, cocaine is illegal.
Yeah.
But it still exists.
Yeah, sure.
People still trade it. It's out there. It's just not mainstream. Okay. It's a commodity. It's traded. I mean.
But now, wouldn't you say it's mainstream because of the ETFs?
Yes. And that is good because now they have Wall Street on their side, or Bitcoin has Wall Street on its side. So that will make it harder for the governments and central banks to attack it because now it's sort of enshrined in our system. So that bodes well for Bitcoin. So maybe buy a little more if you're into it. Yeah.
Anything else?
Yeah. I don't know. I really want to leave people with the idea of the mortgage being an asset.
Oh, yeah.
And even if it's, ideally, the mortgage you have on all your properties is at a negative interest rate, meaning the rate of the mortgage is below the rate of official inflation and below the rate of real inflation. And always remember, too, that depending on your tax bracket, maybe 40% of that mortgage interest is deductible. Yeah. So if your mortgage is, 4%, really your real interest rate is only like 2.2%. Right. Okay. So when you compare that to official inflation rate, which is understated, I'm sure you agree with that, or unofficial real inflation rate, you're definitely at a negative interest rate. Oh. Right. So that's a huge asset. And then the debt is being inflated away. And that happens really in two parts. The payment every month gets less and less burdensome with the inflating the debt away, but also the principal balance of the mortgage gets less and less burdensome because inflation is basically paying it off for you. That's incredible. Yeah, it really is an incredible thing.
Thank you so much. Yeah. How can people follow you?
My website is jasonhartman.com, and I'm on YouTube and podcast, Creating Wealth Podcast as well.
Creating Wealth Podcast. Yeah. Thank you so much.
Thanks, Kevin.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is neither personalized financial nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF and hold long positions in various securities mentioned, including potential short positions. However, I have no relationship to any issuers, nor am I presently acting as a market maker.